Investment strategy number 1. Investing in mutual funds. Investing wisely is akin to charting a course through uncharted waters. In the vast sea of investment opportunities, mutual funds emerge as sturdy vessels, offering investors a diverse and managed approach to wealth accumulation. Mutual funds pool money from various investors to purchase a diversified portfolio of stocks, bonds, or other securities. The mutual fund advantage. Mutual funds provide investors with several distinct advantages. First and foremost, they offer diversification. By investing in a mutual fund, individuals gain exposure to a wide range of securities, reducing the risk associated with investing in individual stocks or bonds. Diversification helps mitigate the impact of volatility in any single asset, fostering a smoother investment journey. Additionally, mutual funds are managed by seasoned professionals. Another benefit of mutual funds is accessibility. With mutual funds, investors can start with relatively small amounts of capital, allowing individuals with varying financial capabilities to participate in the market. Understanding mutual fund fees. While mutual funds offer a compelling investment proposition, it's crucial for investors to understand the fees associated with these funds. Fund managers charge fees for their services, which can significantly impact investment returns over time. Fund managers will often manage their portfolios in ways that maximize their fees instead of trying to maximize your returns. Of course, not all fund managers choose themselves over their clients, and if you have a good one, feel special because it is not as common as it should be. Couple this with the fact that most managers will not even beat the natural growth of the market with their fund. If the market increases by 10% and your mutual grows by 10%, and then the manager takes his fees, how well have you done? So a manager's stock picks would have to beat the market by at least the percentage of his fees for you to just break even. This is not common. It is even less common for the manager to beat the market by enough for you to make gains over other investment options. There are several types of fees commonly associated with mutual funds. Management fees. Management fees are charged by the fund manager for overseeing the fund's portfolio. These fees are typically expressed as a percentage of assets under management, AUM, and are deducted from the fund's assets. Management fees can vary widely depending on the fund's investment strategy and the level of active management involved. Expense ratios. The expense ratio represents the total annual expenses incurred by the fund, including management fees, administrative costs, and other operating expenses, expressed as a percentage of the fund's average net assets. Expense ratios are an essential consideration for investors as they directly impact the fund's returns. Lower expense ratios translate to higher net returns for investors. Load fees. Load fees are sales charges imposed on investors when purchasing or redeeming shares of certain mutual funds. There are two main types of load fees: front-end loads and back-end loads. Front-end loads are charged at the time of purchase, reducing the amount of capital initially invested, while back-end loads are incurred when redeeming shares, often declining over time. Transaction fees. Some mutual funds charge transaction fees, also known as trading fees, for buying and selling securities within the fund's portfolio. These fees are separate from management fees and expense ratios and are typically passed on to investors when transactions occur. Evaluating the impact of fees. Fees may seem like a small consideration in the grand scheme of investing, but their impact can be significant over the long term. Even seemingly modest fees can erode investment returns over time, diminishing the compounding effect that fuels wealth accumulation. Consider the following example. Suppose you invest $10,000 in a mutual fund with an average annual return of 8% over 30 years. If the fund charges an annual management fee of 1%, your investment would grow to approximately $100,627. However, if the management fee is increased to 2%, your investment would only grow to approximately $81,333. That seemingly minor difference in fees equates to a substantial reduction in final returns. In the example, 1% of fees translated to a loss of approximately 20% of the total dollar value. Fees can easily be over 3%, making the fund manager and investment house rich with money that should have been yours. Navigating the fee landscape. While fees are an inevitable aspect of investing in mutual funds, investors can take steps to mitigate their impact. Firstly, it's essential to compare fees across different funds and investment options. Lower-cost funds, such as index funds and exchange-traded funds, ETFs, often feature lower expense ratios and fewer associated fees than actively managed funds. Furthermore, investors should carefully read fund prospectuses and disclosures to understand the fee structure and potential costs associated with a particular fund. Transparent communication from fund managers regarding fees is crucial for enabling investors to make informed decisions about their investments. Investment strategy. Number 2. Unveiling the power of low-cost index funds in investment portfolio. In the realm of investing, the quest for optimal returns often leads investors down a labyrinth of choices. Amidst the complexity, low-cost index funds emerge as a beacon of simplicity and efficiency, offering investors a passive yet powerful strategy to navigate the financial markets. The rise of index investing. Index investing, pioneered by the creation of the first index fund in the 1970s, has witnessed a meteoric rise in popularity over the decades. At its core, index investing seeks to replicate the performance of a specific market index, such as the S&P 500 or the FTSE 100, by holding a diversified portfolio of securities that mirrors the index's composition. Unlike actively managed funds, which aim to outperform the market through stock selection and market timing, which the sage of Omaha, Warren Buffett, says is impossible, index funds passively track the performance of their underlying index. The growth of your index fund will mirror the growth of the market. If 20 years ago you put your money in an S&P 500 index fund, it will have mirrored the index. The S&P 500 has grown from $100 in 2004 to $579.44 in 2023, which is a 479.44% return, or 9.34% per year if you reinvested all dividends. The average annualized return of the S&P 500 between 2003 and 2023 is 10.20%, and the average rate of return since 2013 is 13.05%. Very few fund managers can match these returns, and even less can beat these returns by enough to cover their fees and actually make you more money than the index. The case for low-cost index funds. One of the most compelling arguments for investing in low-cost index funds lies in their simplicity and cost-effectiveness. Index funds typically feature minimal management fees and expense ratios, as they require little active management compared to their actively managed counterparts. These low costs translate into higher net returns for investors over the long term, as fees have a significant impact on investment performance. Moreover, low-cost index funds offer broad diversification, providing exposure to a wide range of stocks or bonds within a single investment vehicle. By mirroring the performance of an entire market index funds mitigate the risk associated with individual stock selection, offering investors a well-rounded and resilient portfolio. Index funds versus actively managed funds. To illustrate the efficacy of low-cost index funds, let's consider a hypothetical scenario comparing the performance of an index fund with that of an actively managed mutual fund over a 10-year period. Suppose investor A invests $10,000 in an S&P 500 index fund with an average annual return of 8%, and investor B invests the same amount in an actively managed mutual fund with a similar investment objective, assuming they actually meet the stated objective. The index fund charges an annual expense ratio of 0.05%. Index funds typically charge between 0.03% and 0.05%, while the actively managed mutual fund incurs a higher expense ratio of 3%. Remember, that is only the management fee. There are other fees as well. After 10 years, Investor A's investment in the index fund would grow to approximately $21,589, assuming reinvestment of dividends and compounding at an 8% annual rate. In contrast, Investor B's investment in the actively managed mutual fund would grow to approximately $15,283, taking into account the higher expense ratio. Remember, the example is just over a 10-year investment period to make the math easy with minimal fees baked in. Depending on your age and your investment horizon, your investment period will probably be longer than 10 years, just compounding the difference. The impact of fees on investment returns. The disparity in investment returns between the two scenarios can be attributed to the impact of fees. While the actively managed mutual fund may seek to outperform the market through active management, which is not as near as common as it should be, the higher fees associated with such funds often erode a significant portion of potential returns over time. Even seemingly small differences in expense ratios can have a substantial impact on investment performance over the long term. In the example above, the index fund's lower expense ratio of 0.05% translates to lower costs for investors, allowing them to retain a more significant portion of their investment returns, which can make a huge difference in your compounding. Investing in low-cost index funds offers investors a straightforward yet effective strategy to participate in the financial markets while minimizing costs and maximizing returns. By mirroring the performance of market indices, index funds provide broad diversification and exposure to the overall market, offering investors a passive yet powerful approach to wealth accumulation. In contrast to actively managed mutual funds, which often incur higher fees and fail to consistently outperform their benchmarks, low-cost index funds offer a compelling alternative for investors seeking long-term growth and stability. With their low costs, broad diversification, and proven track record of performance, index funds continue to gain traction as a cornerstone of investment portfolios, empowering investors to achieve their financial goals with confidence and clarity. Investing in an index fund is the least stressful way to get healthy returns. Just add money according to your financial plan and forget about it until it's time. No worrying about the ups and downs of the market or how current events may affect your investments. Over long periods of time, the market has historically only gone up. Investment strategy number 3. My favorite stock picking strategies. Before we get into a couple of my favorite stock picking methodologies, let us first talk about the difference between a stock market investor and a stock market speculator. Stock market investor. Long-term orientation. Investors typically have a long-term perspective, aiming to build wealth gradually over time through the appreciation of their investments and dividends. They focus on the fundamental value of the companies they invest in and often hold onto their investments for years or even decades. Investors rely on fundamental analysis to assess the intrinsic value of a company's stock. They examine factors such as earnings growth, profitability, competitive advantage, management quality, and industry trends to make informed investment decisions. Risk management. Investors prioritize risk management and diversification to protect their capital. Investors often seek both income and capital appreciation from their investments. They may invest in dividend-paying stocks for regular income, while also focusing on stocks with growth potential to increase their wealth over time. Stock market speculator. Speculators typically have a short-term horizon, aiming to profit from short-term price movements in the market. They are less concerned with the underlying fundamentals of the companies they trade and instead focus on market trends, momentum, and technical analysis. While coming from an informed perspective, speculating is a lot like gambling. Speculators rely heavily on technical analysis, which involves analyzing historical price and volume data to identify patterns and trends in stock prices. Higher risk tolerance. Speculators generally have a higher tolerance for risk and volatility compared to investors. They are willing to take on greater risks in pursuit of higher potential returns, but also accept the possibility of significant losses. Speculators engage in frequent buying and selling of stocks, options, or other financial instruments to capitalize on short-term price fluctuations, exposing them to a higher form of capital gains taxes if they do make gains. Profit from price movements. Speculators aim to profit from changes in stock prices, regardless of whether the market is going up or down. In the dynamic world of investing, stock picking stands as a fundamental art form, requiring astute analysis, foresight, and a nuanced understanding of market dynamics. While the allure of identifying the next big winner can be enticing, navigating the realm of stock picking demands disciplined strategies and a keen eye for opportunity. Now, while stock picking, when done correctly and for the right reasons, can greatly outperform the index, it takes a lot of research, and if you are not an accountant or are not familiar with reading a company's financial statements, it will mean learning new things and different skills. If constantly doing research on companies or learning to read financial statements is not for you, that's okay. Just invest in a low-cost index fund and earn great returns with no work whatsoever. If you think stock picking is right for you, we will explore two prominent approaches to stock picking: dividend investing and value investing, shedding light on their principles, benefits, and considerations for investors. Dividend investing, harvesting income from stocks. Dividend investing revolves around the principle of selecting stocks that pay regular dividends to shareholders. Dividends represent a portion of a company's profits distributed to its shareholders, serving as a tangible reward for their investment. For income-oriented investors seeking a steady stream of cash flow, dividend-paying stocks offer an attractive proposition. One of the primary benefits of dividend investing lies in the reliable income stream it provides. Companies that consistently pay dividends demonstrate financial stability and a commitment to returning value to shareholders, making them appealing investments for income-seeking investors, particularly in uncertain economic environments. Companies that pay dividends are choosing to distribute profits to shareholders instead of reinvesting these profits in the company. Well-established companies usually do this when further growth is difficult. For example, Coca-Cola has increased their dividend each year since 1963. Warren Buffett, CEO of Berkshire Hathaway, says that he feels like he can make more money in the stock market for his shareholders than they can make with the same money he would pay in a dividend. Value investing. Uncovering hidden gems in the market. Value investing, popularized by legendary investor Benjamin Graham and his disciple Warren Buffett, centers on identifying undervalued stocks trading below their intrinsic value. Value investors scour the market for opportunities to purchase quality companies at discounted prices, capitalizing on market inefficiencies and wrong pricing. At the heart of value investing lies the concept of margin of safety. By purchasing stocks at prices significantly below their intrinsic value, value investors seek to minimize downside risk and maximize upside potential. This conservative approach to investing emphasizes preservation of capital while aiming for superior long-term returns. Value investors employ various financial metrics and valuation methodologies to assess the intrinsic value of a company, including price-to-earnings ratio, price-to-book ratio, and discounted cash flow analysis. By conducting thorough fundamental analysis and focusing on the underlying business fundamentals, value investors aim to uncover hidden gems in the market overlooked by the broader investment community. Stock picking represents a cornerstone of investment strategy, offering investors the opportunity to capitalize on market inefficiencies and generate superior returns. Whether pursuing a dividend investing or value investing approach, success in stock picking requires discipline, diligence, and a thorough understanding of investment principles. Choosing your path to financial freedom may involve learning new things and developing new skills, but doing nothing will get you nowhere. If you found this video helpful, go ahead and give us a like and subscribe for more investing advice. Financial freedom can be yours.